don't know that it's the end of the game for LBMA, but what is clear is there's a shortage of silver in the market across the board. And that's why the price is going higher, and it has to go higher to suck out the recycled silver, because if you didn't have recycled silver, there wouldn't be enough to go around.
Certainly triple-digit silver. You mentioned $180 there.
Reported big shipments from America to London of silver. If the supply is not coming in, you then get a kind of leveraged situation when people want silver, but it's in short supply because the leasing rates at one point I heard were up to 40% a year. Electric vehicles, where the amount of silver required is about double what you need for a conventional combustion engine. Solar panels, which also are big consumers of silver. Then we've got central bank buying at record levels for the last 3 years. So buying 1,000 tons of gold a year on average over the last 3 years. They've basically shown that they don't care about what the price is. They just want more gold. We've seen a certain weaponization of the dollar, and it doesn't really matter whether you're friends or enemies with the United States. The size of the move that we've seen has been unprecedented. Having said that, unlike the bull market we saw when the Hunt brothers were buying silver and took it up to $50 back in I think the early 80s or late 70s, which was a speculative mania. This one is driven by fundamentals. We're seeing, we've seen for the last 5 years a deficit in mine production compared with the industrial demand. And that industrial demand is set to increase, partly from electric vehicles, where the amount of silver required is about double what you need for a conventional combustion engine. And of course, we've got an accelerating move towards solar panels, which also are big consumers of silver. So there's quite a large deficit in silver, and the only way to suck out that deficit is through higher prices. But obviously those prices have moved very fast, and that kind of makes it, at least in the short run, kind of speculative. It doesn't mean to say that the bull market is over, not at all. But often when these things happen, you do get a sharp and unexpected pullback before the bull market can resume and go to another all-time high.
This quietly exposes a core imbalance. Silver demand is rising structurally, while supply has been shrinking for half a decade. Industrial pull from EVs and solar is real. EVs using roughly double the silver of combustion engines is not a trivial shift. When a market runs this tight, sharp rallies and equally sharp pullbacks become normal, not abnormal. Even analysts like Clive Thompson have warned about multi-year supply deficits. Investors should remember, violent price action is often a sign of real constraints, not speculation. And what Clive Thompson explains next reveals how exaggerated the path forward could become.
But if we were to take the speculative boom of the Hunt brothers, and I think there was another one a bit later, which wasn't so much speculative, but both of them took silver to around $50, and so this time we've gone to $50. But if we adjust it for inflation, the figure I've heard quoted, and I haven't double checked myself, is we'd have to go to $180 this time around to kind of make a peak similar to the ones we've had before. So when you have large bull markets like this, they can often overshoot. So I'd be a fool if I said it's going to turn around tomorrow. I'm not saying that. It could easily shoot up again tomorrow and the day after. But at some point, when you've got this sort of move, there has to be a pullback. And I think from here on, it's not so much of a steady rise as we have perhaps seen over the last few years. We now go into a phase where the moves are more violent, perhaps 2 steps forwards, 1.5 steps back, 2 steps forwards, 1.5 steps back.
Here's the quiet truth. Inflation-adjusted silver hasn't even matched its historic blow-off peaks, which would imply prices near $180, not $50. When seasoned analysts mention overshoots, they're pointing to the same behavior seen in commodities during tight cycles, such as oil's 2008 spike. Volatility clusters when fundamentals and speculation collide, creating the 2 steps forward, 1 step back pattern he describes. For portfolios, that means timing is less useful than disciplined allocation. Next, Clive Thompson gets into how investors should navigate this volatility without chasing tops.
And of course, if you're a person who doesn't feel he's got enough silver, the way to play the game is to ease in gently a little bit now, which is painful because you're buying at the all-time high, but keep some in reserve so you can buy some perhaps in 10 days or 30 days time. Might be higher, might be lower, but either way, you can't be sad that you paid everything at the highest price.
Yeah, that's a great perspective. And certainly triple digit silver, you mentioned $180 there. I believe that statistic is using government inflation data. So perhaps if we're talking real world inflation, the price could be even higher to get back to that previous all-time high.
This is the rare moment where an expert openly admits dollar inflation metrics may understate silver's true historical equivalent. Dollar erosion since the 1980s is far deeper than CPI suggests. Shadow stats and other auditors show real inflation could be multiples higher. His dollar cost averaging logic reflects how institutions accumulate metals, gradually, never all at once. Investors should treat this like a liquidity cycle, not a lottery ticket. What comes next shifts from retail strategy to structural inventory risk.
We've been hearing a lot of talk about continued stress on LBMA silver inventories, with many analysts seeing it as a major issue that could be one of the catalysts currently driving the silver price. I'd love to get your thoughts. Do you see there currently being a supply squeeze on at the LBMA? And if so, what could the implications be on the silver market moving forward?
I've seen a number of estimates of the shortage of silver at the LBMA. One estimate said there's only 6 weeks supply ahead, and another one said there's 4 months. So that's quite a big difference. But the bottom line is, it does seem that silver inventories at the LBMA have been shrinking for years. And of course, what's left is going to be very much spoken for in terms of it's leased out or it's held by an institution which has no plans to ever sell it at any price. So when you have a situation like that, and if the demand continues to be higher than the supply coming in, and by the way, there has recently been a report, I haven't read into it, but a report of big shipments from America to London of silver. But if the supply is not coming in, you then get a kind of leveraged situation when people want silver, but it's in short supply, because the leasing rates at one point I heard were up to 40% a year, which kind of means that people will say, you need silver? Borrow it from us and we'll charge you a lot of money.
This part drops a red flag Wall Street rarely acknowledges. LBMA supply estimates range from 6 weeks to 4 months, a spread so wide it suggests no one truly knows what's left. Shrinking inventories over multiple years point to chronic structural shortages, not temporary drawdowns. Leasing rates spiking toward 40% is another institutional tell. Markets only price that kind of stress when underlying metal is genuinely scarce. Investors should track whether shipments into London keep rising, because that's where real pressure leaks through. Next, Clive Thompson moves into the most controversial topic of all, the CME freeze.
So it kind of implies that there were some real problems at the LBMA. But one of the funny things about if you have a high leasing rate, silver will flow in. Because people say, I want to take advantage of it. So I don't know that it's the end of the game for LBMA, but what is clear is there's a shortage of silver in the market across the board. That's absolutely clear. There's no doubt about it. And that's why the price is going higher, and it has to go higher to suck out the recycled silver, because if you didn't have recycled silver, there wouldn't be enough to go around.
We saw a freeze on all trading at the CME last week, I believe it was Friday, on what was described as a cooling issue. Are their systems really this susceptible to technical problems? Many people online are not buying it, and a lot of people were pointing to the rising silver price as the cost. Of course, we know silver bugs love to be conspiratorial minded. I'm one of them, so I totally get it. But people were saying, okay, they took a break so that the shorts were able to get out of their positions. They're running cover for the bullion banks. I mean, there was all sorts of chatter out there on social media about what was actually happening.
When leasing rates spike, metal magically appears, revealing just how stressed the LBMA pipeline really is. The speaker points out an undeniable market-wide shortage, yet institutions still frame it as business as usual despite years of declining inventories. Add the CME cooling issue freeze conveniently happening at peak price action, and it raises uncomfortable questions about who benefits when markets pause. Even if not coordinated, timing alone affects margin exposure and short-side liquidity. And what comes next digs deeper into the mechanics behind that suspicious halt.
What are your thoughts? Do you think this really was a technical failure, or do you suspect something more sinister lurks behind the curtain?
Well, I'll tell you what I think in a second, but let's just start by saying it's never a great idea to trade a conspiracy theory.
Yeah.
So, now, in this case, it obviously was rather convenient that things broke down just at the high point, just as it was hitting a peak. And in a way, one could say that maybe gave the shorts some kind of breathing space to figure out what they're going to do without getting margin calls while the silver price was hitting all-time highs. So they can't send out a margin call in the middle of the day or think about a margin call if there's no price to make a margin call. But what we did see, which was quite interesting, during the period when the shorts could no longer roll over their shorts or do whatever, or initiate new shorts, the spot price rose sharply. I think it went up by 5.7% on the day. So in one sense, that kind of shows us what the real supply and demand might be if it weren't for what everyone suspects is market manipulation. And I want to stress, I'm not part of the conspiracy group. I don't really believe that there's market manipulation going on, but I have to accept that it is a possibility.
Here we get a rare data point. A 5.7% jump in spot silver when shorts were temporarily unable to act, exposing what unfiltered supply-demand may look like. The speaker avoids conspiracy claims, yet still acknowledges the convenience of a system break exactly at all-time highs. That timing matters because margin call mechanics and liquidity pressure peak during those moments. When structural frictions align with market stress, institutions gain reflexive advantages even without intent. Next, Clive Thompson shifts toward whether randomness can really explain these recurring coincidences.
But I think this overheating was just convenient and not necessarily sinister. But what causes overheating? Why that day and why not any other day? I don't know. There's got to be a nagging suspicion. But I'll put it down to randomness.
Okay, well, I want to shift to the gold sector now. Obviously, both gold and gold miners have also been performing exceptionally well this year. What would you say are the main catalysts that brought us here? A lot of people are pointing to central bank buying, as some people even say that's the number one reason. Others point to rising geopolitical risks, debasement of the US dollar. I mean, take your pick. There's so many theories out there. So what are your thoughts? And would you say we are closer to the beginning or the end of this bull market as it stands today?
Well, I certainly don't think we're at the end or even the middle of it. I think this is late beginning. In terms of what's driving it, well, we've got a lot of things driving it at the moment. Some of them have been around for a few years and some of them are relatively new. We've got the fiscal deficits in the United States.
This pivot shows the speaker trying to dismiss suspicion while acknowledging the timing nagging at him, which mirrors how many investors feel, skeptical but cautious. His shift toward gold highlights a sector fueled by structural forces, massive U.S. fiscal deficits, rising geopolitical tensions, and relentless central bank accumulation. When early-stage bull markets look like middles, it's usually because liquidity and policy distortions mask true demand. Investors should track fiscal updates and Fed meetings, as both now directly shape precious metals momentum. Next, Clive Thompson unpacks how deficits and dollar credibility intertwine with gold's surge.
Let's face it, what happens in the United States is very important to the value of gold and silver, because the less confidence people have in the US dollar, the more they're going to look for alternatives. And at the moment, there doesn't seem to be enough actions to address those deficits, which are set to be the largest ever on record this year. This year started in October. That's the fiscal year for the United States. So it's going to be at least 2 trillion of deficit, the highest ever. We've got lower rates coming from the Federal Reserve, or at least that's the opinion at the moment. Now that can change because I know it's not 100% certain they'll lower rates in December. But the opinion at the moment is we've still got lower rates coming. Then we've got central bank buying at record levels for the last 3 years. So central banks have shown over the last 3 years buying 1,000 tons of gold a year on average over the last 3 years. They've basically shown that they don't care about what the price is. They just want more gold. And there's a good reason to want more gold. And that is, we've seen a certain weaponization of the dollar. And it doesn't really matter whether you're friends or enemies with the United States.
This section reveals the structural backbone of the entire metals rally. The U.S. running a projected $2 trillion deficit, while central banks buy 1,000 tons of gold per year without regard to price. When the global reserve currency shows fiscal strain and geopolitical overreach, alternatives stop being speculative. They become necessary hedges. Rate cut expectations only amplify this demand by weakening real yields. For investors, this isn't panic. It's the logical repricing of trust.
You've got to think, what if I suddenly can't get my hands on, or I can't deploy my dollars for some reason? There's been a lot of surprises in the last 11 months, if you know what I mean. Surprises that people never saw coming, and a lot of seesaw, whipsawing back, they call it the taco thing, the taco trade. Trump always chickens out, but it's not really that. But the point is, you don't know where you stand from one day to the next. One day you've got a tariff, next day you don't, then you do, and then there's a retaliation from another country. So things are a bit chaotic when it comes to investing, and particularly relying on the dollar. So I think people are looking for something which can't be restricted. It can't go to zero. So in that respect, gold is coming in. So then we've got the geopolitical events going on. That's not new. Geopolitical events have always been there, but obviously people think that there's a heightened tension at the moment. And that, again, is a reason why people would want to lay their hands on gold. When I say people, I'm talking about countries. And a lot of the buying has been coming from third world countries, like China, Kazakhstan, Poland, those sort of things.
This part quietly exposes a deeper instability. When countries start acting like the dollar might not always be accessible, something fundamental has shifted. Investors are facing a world where tariffs flip overnight and geopolitical risk feels permanently elevated. As Clive Thompson often warns, when policy becomes unpredictable, capital seeks safety, not yield. That's exactly why emerging market central banks, China, Kazakhstan, Poland, are building gold reserves at the fastest pace since the late 1960s. The speaker hints at a confidence erosion that institutions won't say out loud. And next, Clive Thompson reveals why this gold bid may escalate as currencies evolve.
I don't mean to be derogatory, call them third world countries. They call them not the Western countries, shall we say? That's kind of what I meant. That's kind of where the buying is coming from. Countries which are maybe not, as of today, the greatest friends of the United States. They're not enemies either, particularly, but they're just, well, maybe some of them are, but they're just sort of saying, let's get some just in case. But I think there's also something going to continue to drive it in the next few years, probably out to 2027, 28, 29. And that's the coming digitization of currencies. We've got, starting next year, the rollout, to start with, of the digital euro, and that will go fully live the year after that. Now, I don't want to go into too many details because it's a very, very long topic, but the long and short of it is, I think you better get your gold before you've got the digital euro arrives. I think that's my, and if anyone wants to know why, look at my last video, but really get your get your real gold before the digital euro arrives, because you will perhaps find that you will no longer be able to deploy your assets in the way you want, your money in the bank in the way you want to.
Here's the quiet market signal buried inside this paragraph. Gold demand is rising not just from geopolitics, but from the coming wave of currency digitization. The ECB's digital euro pilot begins next year, and even BIS reports note that programmable money could restrict certain types of transactions. That's why countries at odds with the US, not adversaries, but cautious players, are hedging ahead of 2027 2029. Clive Thompson's warning aligns with what Zoltan Pozsar calls the exit from dollar operational dependency.